All right, guys, welcome back to Trinity Training. This is going to be a very powerful video. If you guys master this one, it's going to blow you out of the water. But this one's called the history of insurance. So let me tell you the different kinds of insurance that there is, because one thing you're going to run out of in the field is people that tell you like, hey, I already have an insurance, or I already have something good. And you're going to need to be able to know how many kinds of insurance there is, what's the good, what's the bad about all of them, and be able to compare them and contrast and making sure that you give the right thing for our customers at all the time, okay? So let me tell you about insurances, the good and the bad about them, so you can make your customers decide which one is better for them. And instead of you being a sales guy and trying to push a product because you only sell a certain kind, we have everything that is out there, so you don't have to do it. You kind of just have to educate them and show them the options that they have, and they're going to decide which one's better for them based on the knowledge that you're able to give them, okay? So let me show you that, okay? So the history of insurance. So Mr. and Mrs. Klein, let me tell you a little bit about the history of insurance. So there's obviously different kinds of insurance, and because we don't belong just to one company, we have everything that is out there. So my job for here today is not to try to convince you to buy our product. I know there's companies out there that only sell certain kind, and they tell you why that one's the best, and they talk bad about everybody else, and that's not us, because we got everything out there. So my job is more to educate you and show you the good and the bad, so that me and you can make a better decision on what's better for you and your family. Is that fair? Yeah, that's fair. Awesome. So let me tell you the story of it. So the first type of insurance that there is something called accidental life. So accidental life insurance is usually the cheapest kind that there is, the most affordable one, the one that they sell at the banks, or maybe they do it over the phone, or they tell you, hey, you can have a $500,000 policy for $10. Why are they so cheap? Because the only way that you're ever going to get that money is if you pass away during the accident, okay? So if you pass away later on after consequences of the accident and stuff like that, it might not pay you. So if the ambulance comes and picks you up and you got one of those, tell them, hey, don't pick me up until I die, okay? I'm just kidding, but not kidding, but yeah, kidding. So that's accidental life, okay? The second one, there's something called a term insurance. So term insurance is good for 10, 20, 30, 35 years, depending on what company you go with. But a term insurance is not that it's good or as bad, it's just meant to cover a period of time of your life, and that's it. So if you're the type of person that thinks like, hey, I just need to cover the next 20 years while I pay off my house, while my kids grow up, while my responsibilities go down, then all you might need is just a term insurance to cover that period of time of your life, okay? Usually the term insurance, you can continue until your age 85 with our companies to 105, but it is going to go up in price as soon as you hit that mark of the years that you bought it, okay? So just for you to know that, most of the people that buy a term insurance, they just keep it for that term and it's done. So then after that, they came up with something called a return of premium term, which is again an insurance. It's a term insurance for 20 or 30 years. What's the difference between this one and this one? Well, the one that, the return of premium, actually they'll give you your money back. If the 30 years go by and you haven't passed away, well, guess what? The company will give you, some companies will give you 100% of your premiums back, which is really cool. But what's the catch? That if this one's $100, this one's probably going to be $200. It's usually double the price, but at least you get your money back. So you never know which one's better, right? So that's a return of premium. So this is the type of insurances that are terms. They're only for a period of time in your life. So then after that, they invented something called permanent insurance. So permanent insurance, there's a few kinds of them. The first one is called a whole life. So a whole life insurance is meant to cover the rest of your life. So the purpose of that one is to cover the rest of your life. It does have a couple benefits on there. So one of those benefits is that it actually accumulates you a cash value in there. The only challenge with the cash value is that it makes you only 2 to 4%. And you also have something called a level premium, which means that if you put in away $200 a month, you can never put it up or put it down. You don't have the flexibility. It's always going to be the same $200. So putting it up or putting it down is not an option for you. Also, the loans that you get on this money, you get expected to pay a 6 to an 8% loan. So it kind of doesn't make sense. You're making a 2 to 4, but you're getting charged a 6 to 8 to borrow your money from that. So whole life policies are not really meant for the cash. They're just meant for people that want to have a permanent policy. That say, hey, I just want to have an insurance the rest of my life. I really don't care about the cash value. I just want to have an insurance that is going to be for the rest of my life, and I want my premiums to stay the same for the rest of my life, okay? So that's whole life. After that, they came up with something called universal life. So obviously what they changed is the word universal. So with the universal life, what they try to do is they try to fix a couple things. So it's another permanent policy. It also builds you cash value. It also makes you 2 to about 4% interest, okay? And the loans on this, it's actually level, but they added something called increasing. So increasing means that now if you're putting away those $200, you can actually put away more money or put away less money depending on how you're doing financially. So some people started like that option because you have flexibility. If you have more money to save, you could save more. If you got tight financially, you could reduce it. So you didn't have to be stuck with the same $200 all the time. The loans on this one, it is the same, about 6 to 8%. So it didn't kind of make sense because you are getting charged again 6 to 8 to loan your money out, but you are getting credited 2 to 4. But at least you have the flexibility where you could put more money, put less money away. But again, it's meant for a permanent policy, not necessarily for the cash value, okay? So what they did next is they came up with something called an Index Universal Life. So what this is another permanent policy, the same thing. It also accumulates your cash value in there. The difference now is that the interest rate that this one gives you about 6 to 9%, depending on what company you go with, which is pretty cool. They still have the increasing death benefit, which means that if you put away $200 a month, you could also put it up or put it down, depending on how you're doing financially. But now the difference is the loans on this one, depending on the company you go with again, but most of the loans is at 0.75 or even a 0 in some cases. What they call a wash loan, where they credit you the same amount what they're charging you, which you end up not paying anything on the loan. So this one makes a lot more sense now because you're getting good interest rate, but you're getting charged a little bit to get your money out. So your money's still making money as you're loaning yourself some money from there. So that was pretty cool. So now the other thing that they did with insurance is they added something called long-term care, and they added something called living benefits. What that means is if you ever get something chronic, critical, or terminal, you actually have some access to your money while you're alive. So that was pretty cool. So now, before it used to be that it just if you were to pass away, your family would get some money. Now in some companies, if you get something chronic, critical, or terminal, if you get a cancer, heart attack, a stroke, anything like that where you need assistance or you can't do the daily living activities, you actually can have access to some of that money. So not all products have these benefits, but I know the Index Universal Life does. I know term insurance does with some companies. So again, talk to your rep. It doesn't necessarily mean that one product is better than the other. You just gotta understand what you have. And if you have an accidental life, and then if it's only gonna cover you in case you become an accident, if you have a term insurance, you gotta understand that it's only a period of time that you're gonna have it for, and then it's gonna expire on you. If you have a return of premium, same thing. It's a term, but at least it'll give you your money back. If you have a whole life as a permanent insurance, and that's pretty much all you're gonna use it for, because the cash value is not that great. If you have a universal life, it gives you a little more flexibility with your premiums, but that's all you're gonna have. Again, it's just a permanent policy with a little bit of cash. And then if you have an Index Universal Life, and now you have the ability to really save some money in there where you can withdraw it with loans and stuff like that. And you can make some good interest rate. It also keeps it safe from losing money. All this money that gets accumulated in all these policies, you never pay taxes on that either, so which is pretty cool. So again, make sure you add long-term care or living benefits to your policies, because you never know. If you pass away, your family gets some money. If you become disabled, you get some money. So again, it's not that one is better than the other. It depends on which one you want. So I don't know which one you have, Mr. and Mrs. Client, but which one do you think is better for you and your family now that you understand the good and the bad about all of them? And then let them make the decision. So you go from there, okay? See ya.